Today, via this video, we are going to discuss deferred tax assets which appear in balance sheet. The topics cover concept of deferred tax asset, deferred tax liability, numerical examples to understand the DTA and DTL, and classification of DTA and DTL in balance sheet of a company. There are two acts. One is the Companies Act and the other is Income Tax Act. Sometimes the profit calculated by the company as per the Companies Act differs from the profit calculated by the Income Tax Act. The above difference occurs mainly due to 1. Difference in rate of depreciation on the assets applied as per the Companies Act and applied as per income tax. Number 2. Disallowance of certain expenses which the company includes in its statement of profit and loss account as per Companies Act but disallowed by the income tax authorities as per IT Act. Deferred tax is an accounting item covered under Ind AS 12 income taxes. This is introduced in 2001. Examples for rate change in rate of depreciation. Say for example, general plant and machinery income tax allows 15% of depreciation, whereas the Companies Act allows up to 25%. Furniture and fittings 10% by Income Tax Act and 20% as per Companies Act. Similarly, mining equipments 43.77% as per income tax and 31.23% as per Companies Act. General disallowance of provisions as per IT Act. The IT Act generally disallows certain provisions unless they meet specific criteria. For example, provision for doubtful debts is not allowed under section 36(1)(7) unless the debts are actually written off. Provision for gratuity is disallowed under section 40(a)(7) unless paid to an approved gratuity fund. Provision for taxation is disallowed as taxes are allowable only on payment basis under section 43(b). Let us see an example. The profit before tax as per Companies Act is 1 lakh. The tax at the rate of 30% comes to 30,000 rupees. Profit before tax as per IT Act 80,000. Tax at the rate of 30% works out to 24,000. We are going to understand the deferred tax liability concept. The company will always pay tax as computed as per income tax. In the present scenario, the company will pay rupees 24,000 as income tax and show the difference as deferred tax liability. Deferred tax liability occurs when taxable income is less than the accounting income during the accounting period. In other words, when the income computed as per Income Tax Act is lesser than profit calculated as per accounting standards, the difference between those two results in deferred tax liability, that is DTL. Now we will take a numerical example. Income Tax Act, the rate of depreciation on the plant and machinery used in mines and quarries is written down to value 43.77%, say 44%. As per Companies Act, the rate of depreciation which can be applied on plant and machinery used in mines and quarries is written down value 31.23%, say 31%. Assuming the cost of excavator used in mine is rupees 40 lakhs, the amount of depreciation as per Companies Act and Income Tax Act would respectively be rupees 13.64 lakhs and rupees 19.36 lakhs. In this case, the rate of depreciation is higher as per IT Act. Now, looking at the example, the profit before depreciation and tax is 50 lakh as per Companies Act, and depreciation as per Companies Act at the rate of 31% works out to 13 lakh 64,000. So profit as per books will be 36 lakhs 36,000. Tax at the rate of 30% works out to 10 lakh 90,800. Now look at the same scenario as per Income Tax Act. Profit before depreciation and tax is 50 lakh. Depreciation as per IT Act at the rate of 44% is 19 lakh 36,000. So profit as per IT Act will be 30 lakh 64,000. So tax at the rate of 30% works out to 9 lakh 19,200. So the company pays tax of 9 lakh 19,200 as per IT Act and shows the balance amount of rupees 1 lakh 71,600 as deferred tax liability. Now let us understand the deferred tax asset, how it occurs. The profit before tax as per the Companies Act is 80,000 and the tax at the rate of 30% works out to 24,000. Profit before tax as per IT Act is 1 lakh and tax at the rate of 30% works out to 30,000. The company will always pay tax as computed as per income tax. In the present scenario, the company will pay rupees 30,000 as income tax and show the difference as deferred tax asset. Deferred tax asset occur when the taxable income is higher than the accounting income of the current accounting period. In other words, when the income computed as per Income Tax Act is greater than profits calculated as per accounting standards, the difference between those two result in deferred tax assets. Now let us understand deferred tax asset further. Disallowance of certain expenses. Deferred tax assets can also form when expenses are recognized in the income statement before they are recognized in the tax statement. For example, some expenses, though shown as expense in the income statement, are not considered for deduction in the tax statement to arrive at the taxable profit. For example, more depreciation claimed in books than in tax, provision for doubtful debts, gratuity provision, prepaid expenses, notional losses booked that is disallowed under the Income Tax Act are some of the cases that results in deferred tax assets. Now look at the example. As per Companies Act, the revenue is 1 lakh. It has claimed the expenses of 20,000. So profit as per books works out to 80,000. Tax payable at the rate of 30% works out to 24,000. Now let us go to the IT Act. Revenue 1 lakh less expenses allowed by IT Act is 10,000 as against 20,000 claimed in the books of account. So profit assessed by the income tax is 90,000. Tax payable at the rate of 30% works out to 27,000. The company now pays income tax of 27,000, whereas as per the company's books, the tax payable is only 24,000. The company treats the excess tax of 3,000 as deferred tax assets. Now, over a period of time, the liability get reversed. I will give you a numerical example. A company purchased an instrument for use in R&D department at a cost of 12 crores. The company would use SLM method of depreciation at the rate of 2 crore per annum for 6 years. The income tax law permit full depreciation of 100% during the first year of such instruments. The company would create a deferred tax liability in the following manner. Now look at the 6 years protection. As per Companies Act, say profit before depreciation and taxes is 12 lakhs, 14, 16, 19, 22, 25. Depreciation as per the Companies Act is 2 crores per annum. That is over a period of 6 years, the entire depreciation is applied. Now the profit before tax works out to 10 crore, 12 crore, 14 crore, 17 crore, 20 crore and 23 crore. And provision for taxation works out to 4 lakh, 4.8 lakh, 5.6 lakh, 6.8 lakhs, 8 lakhs and 9.2 lakhs. Now look at the Income Tax Act. The profit before depreciation and taxes is 12 crore, 14 crore, 16 crore, 19 crore, 22 crore and 25 crore. Depreciation as per IT Act, in the first year itself, 12 crore is written down. So for the balance years, the depreciation is 0. Now the profit before tax will be 0 in the first year, 14 crore, 16 crore, 19 crore, 22 crore, 25 crore in subsequent years. So provision for tax at the rate of 40% to 0, 5.60, 6.40, 7.60, 8.80 and 10 crore. So deferred tax created is 4 crore. It is a DTL. The next year it will be a 0.8 DTA. Next year also, subsequent years also, it works out to 0.80 crore, which is a DTA. Now, the net effect in the balance appearing as in the first year, DTL is 4 crore. Adjusting for the DTA of 80,000, the second year it is 3.2 crore, 2.4 crore, 1.6 crore, 0.80 crore, and in the sixth year, it gets wiped off. Now the classification of DTL and DTA in balance sheet of companies. The liability sides are divided into shareholders fund, then non-current liability, then current liability. The deferred tax liability will be shown under the head non-current liability. When you look at the asset side, we have the non-current assets and the current assets. So the deferred tax asset, if it occurs, it will appear under the head non-current assets. Thank you. Shall come out with such small videos on lending topics. Subscribe to my YouTube channel NPIers Learning Modules in Lending and click the like button, which enables you to get notifications whenever a video of mine is uploaded. Follow me on Facebook and on Instagram.